Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The S&P hit new highs, but the Nasdaq hasn't been near its top since spring. Crude is reacting to the violence in the Middle East, but surprisingly, gold really isn't much higher. Author of several books on the economy, including The Money Bubble, John Rubino, chats about whether we're on the brink of World War III and how financial markets could react to that, the outlook for crude, and where our energy future could lie. Publisher of the Campbell.Real Estate Timing Letter, Robert Campbell, checks in from San Diego. He tells us Florida is no longer the go-to state for real estate. He also answers the question, will lower U.S. interest rates spark the economy and real estate? We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be back, Jim.
How did the stock markets do this week?
Well, a little bit of a sideways action. You know, we peaked out a week ago with some pretty strong moves. And then this week was a little choppy. And at the tail end of the week, the employment numbers were enough to give a spurt to the upside. So you got the Dow and the S&P just up there within a hair of their all-time highs again. The Nasdaq is having some difficulty. And, you know, ever since the Magnificent Seven peaked out back in June and July, they've just been spending time backing and filling here. Now, you know, from a seasonal perspective, typically you would look for a good buying opportunity at some point in October, November. And, you know, if you take a look at the fact that the market right through the end of October was strong, right into of September was strong, right into the 1st of October, about 20% of the years see strength like that, which then results normally in at least a sort of a grinding to the upside for the first week or 10 days in October. But by the time you get to around the 10th or the 12th of the month, things are ready to roll over and have the correction. So at this point, wouldn't be at all surprised in the next week or 10 days that, you know, what the news items are, we don't know. There's the potential of something happening between the Israelis and Iran as a repercussion to what has gone on in the early part of this week. So, you know, maybe there's going to be some violent action at some point in the week or two coming up. Ideally, we get enough of a sell-off to give some good oversold readings and we get some attractive buying entry opportunities. So, typically, if you've had a strong September like this, you're going to roll over in the early part of October, and that correction can take anything up to 3 or 4 weeks. The key is going to be looking for a good oversold low, and our research shows that there are specific requirements that really do kick in most of the time on the corrective low. It could be that we've been up and then we come back to where we are right now. But if we roll over around this level, probably looking for something that could be anywhere from 5 to 10% lower before we get that entry opportunity. So I think patience is what's important right now for anybody who's looking to take a seasonal trade through the fourth quarter of the year. which historically is, the best calendar quarter that you see. So let's be ready for something and have some powder dry as a correction appears.
How did crude react to the violence in the Middle East?
Well, this sort of caught me off guard because I'd been looking at crude as having had a good low the 1st of September, a recovery into resistance, and then a retest of the lows at 66. But with the attack by Iran on Israel, the movement was very significant, very quick here. We've gone from 66 and change up to 74 and change at the end of the week. So pretty big run, best percentage rally that we've seen in months now. Once again, we're back towards resistance levels, but it's going to be, I think, news driven next week as to just what happens in terms of the retaliation that Israel has. So, it's not something for the faint-hearted by any means. If you take a look at the stocks in the energy complex did extremely well this week. And on a relative basis, you look for the ones that had been strong already and holding up. And probably Exxon is the one that jumps out the most. It has been, it's one of the major players in terms of the ETFs. And the movement at this point has been pretty darn good. The lows that it put in on the correction back in September were well above the June lows, and it's right back to all-time highs at this point. So, if you're not in and you're looking for something that's just a little more conservative than the really volatile items, something like the XLE ETF or the Exxon, which is one of the biggest items in that ETF, might be worth looking at.
Did gold react to the wave of missiles from Iran?
No, not to the same extent that one would expect. Here we are. We're closing off the week at 26.53. The bottom end is just under 26.40. The top end at 26.80. So we're absolutely midpoint as far as the trading range is concerned. We've been actually at this price level for 7 or 8 days. Not a lot happening there. I think one of the important things is just the action that we've seen in the U.S. dollar index. The dollar, as you know, we've been watching the 20-day moving average as a resistance level, and we had bounced off the August low up and tested the 20-day moving average twice in early September, again in mid-September, and then as we've gone into October, we closed on Monday above the moving average, and this then relates to what was going on with the attack by Iran, and the moving average. Not only did we get up to it, but we crossed through it, and the moving averages started to curl higher. So anytime that we've seen that in the last 2 or 3 years now, we've seen a pretty decent run to the upside. So in this case, crossed the moving average at about par 75. We're up at 102 and a quarter. So that's the best rally in the dollar index that we've seen in quite a while. That then, puts a headwind as far as the gold market is concerned, because, we're talking about gold priced in U.S. dollars. And in this case, with the dollar moving like that, it does put a lid as far as the upward pressure is concerned. Ideally, what we want to do here is get a nice overbought run in the dollar index that gives us a corrective low in the gold market that we can look to be buyers of.
What's going on with the Canadian dollar?
Canadian has had pretty good action. If we take a look at the last couple of months here, it bottomed in August, and from August through September, it was outpacing what on the upside, the action that we were seeing in the crude oil and in the CRB index, the Commodity Research Bureau index. We like to look at the periods when the dollar is divergent relative to those indices. And when they, in the case of the strength there, that was good and positive bias for the Canadian dollar up until about 10 days ago. But having topped at 74.40 here 10 days ago on the Canadian dollar, it has eased off all the way back to 73.60 at the same time that the crude oil has made the good run from $66 and up, and the CRB index has made a higher high. So both the CRB and the oil market are at the best levels we've seen in weeks. The Canadian dollar is just not participating at all. It's grinding its way to the downside, and that kind of action, as we showed in the charts that we sent out this week, that would suggest that there's still further weakness to come in the Canadian, that it's had its run on the upside, and until we see something positive on the downside in terms of the dollar holding relative to the CRB and the crude oil market, you're going to be looking for a downside bias on Canada.
What's going on with uranium?
Well, what's good for the oil market and energies has definitely been very good I should say it's been good for uranium, but just excellent in terms of the action in the uranium stocks. Uranium itself, futures contract has gone from in the last month from 79 up to 82.5. That's come off a good oversold low that we put in at the first week of September. One of our capitulation signals really kicked in right there. At the same time, the major names in the industry, such as Cameco, generated good oversold readings, then came around in double bottom and have been doing very, very well coming off the small move in uranium, but the excellent move in terms of the stocks. We've gone from $36 to $51.5 in Cameco in just a span of about 3 weeks here. A good part of the move was in this last week or so when we've gone from just under 48 up to 51. The complex has looked good since the bottom back in 2000. Had that big correction off the high this year, and if anything, looks as though it's ready for the next significant leg on the upside.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, John Rubino next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.substack.com. He's speaking to us from Washington State. Welcome back to the show.
Hey, Jim.
John, how close are we to World War III?
We are the closest we've been in our lifetimes. That's how close. It's a very scary time. We've got, obviously we've got the U.S. proxy war in Ukraine, where we're handing the Ukrainians weapons capable of striking deep inside Russia, who has said that that's a red line that could result in a nuclear response, yet we're doing it anyhow. We got that going on. And now in the Middle East, we've got Israel basically fighting I don't even know how many fronts they're fighting on right now. Several. So they're pacifying some of the Palestinian territories. They're now actively bombing Lebanon, and Iran is getting involved in it. So Iran just shot some missiles at Israel, who now is promising a serious response against Iran. The U.S. is moving troops to the Middle East, so it's a complete mess. And 95% of it is the United States' fault. So that's what that is. And it's completely conceivable that this spins out of control from here into a major shooting war in the Middle East involving the U.S. and interrupting the supply of oil around the world and spiking oil prices. So, it's completely possible that we have $150 oil in the coming year, and in the U.S., $7 to $10 gasoline, and we're heading into a presidential election. It's a huge mess. So let's just pray that this is as bad as it gets, and people start talking instead of shooting, and we pull back from the precipice. But I don't know. The people who are involved in it now don't really seem like that's what they want. So. You and I, Jim, normally talk about the coming financial crisis, which is at least an understandable, survivable thing. World War III, not necessarily so much. So again, here's hoping that this is as bad as it gets. But I'm not optimistic based on how people are behaving right now.
Yeah. Now, traditionally, we always think of wars being missiles or bombs being exchanged and soldiers marching around. But now it most likely would be economic and cyber attacks, your computers crashing, your hospitals no longer being able to function, that kind of attack. And the Chinese are very good at it.
Well, I forgot to mention China. Yeah. We've got ships in the South China Sea bumping up against their ships. So anything could happen over there. But there will be missiles. I mean, there are missiles right now being shot at people, and there are soldiers shooting at each other, and there are artillery shells blowing up random places where the shells fall. That's all happening. But yeah, you're right. We have all these new things that we've never really used in serious warfare before, like cyber attacks that shut down power grids. There's this thing called an EMP attack, where somebody shoots or detonates a nuclear weapon in the atmosphere. It fries all the electronics for hundreds of miles in every direction. And we got robots now, and they now have robot dogs. Basically, they look like dogs that they are mounting 50 caliber machine guns on the back of. And they can send those things out, run by rudimentary AIs, and that are in theory supposed to be able to pick the good guys from the bad guys and kill the bad guys and leave the good guys. No, we're doing all this stuff, and we don't have the faintest idea what happens when all of those things combine on the battlefield. So this is. If historians are alive to write about this period of history, they're gonna call this the dumbest bunch of idiots in charge of the most sophisticated technology ever in the history of the human race. Because that's what it is.
Wasn't it Albert Einstein who said, "I can't predict how World War III will be fought, but World War IV will be fought with sticks and stones"?
Yep, we are more close to that now than a lot of people realize, and that's the optimistic scenario. Yeah. We're assuming there will be a World War IV because there will be people around to fight it, but that's absolutely not guaranteed. What a world! Enjoy it while it lasts.
Maybe the people stuck on the space station from Boeing are the lucky ones.
Yeah, who would have thought that working for Boeing is actually a life-changing job now? I don't know.
Well, you get to be commander of the space station because you've been up there so long.
It's funny. That's a theme in science fiction movies right now, is that the people stuck up on a space station look down, and all of a sudden there's no radio traffic or anything, and the human race is basically ended. And then what do the people on the station do? That never ends happily. Watch any of those movies, and it's always at least ambiguous and usually horrifying at the end.
Well, maybe the cockroaches will be the next civilization.
Mm-hmm.
Mm-hmm. Now, what could U.S. involvement in a shooting war do to the financial markets?
that's something we can react to and change our behavior in light of. So at least it's something where we have some agency. A shooting war. Let's say we start killing Russians and Russians start killing us. Okay, in Ukraine, that's incredibly possible right now, if not probable. That would freak the financial markets out big time, and we are so financially fragile. We've taken on so much debt in the last 70 years, and especially in just the last 5 years, where we've added something like $11 trillion to the U.S. national debt and a whole bunch of trillions of dollars to individuals and corporate debt. So, a shooting war that freaks out the financial markets would lead to a dramatic bear market in equities. In other words, a stock market crash. And what it does to the bond markets is hard to predict because, the effect might be very inflationary of people reacting to a war. And that would be bad for bonds, or it might be very deflationary, and that might be good for bonds. But it would be horrible for stocks, other than the defense stocks and possibly the gold miners. But everything else tanks. And it would probably be very good for precious metals, because it would lead people to look for the safest of safe havens, which is that is gold and silver. So people would be cashing out a lot of their dollar-denominated assets, or at least Chinese yuan and euro-denominated assets. The dollar is the final piece of this puzzle. And the weird part of today's global financial system is that trouble in the world, even if the U.S. causes the trouble, sometimes leads to a stronger dollar, because people assume that the U.S. will be the last financial entity standing, and therefore it's the safe haven. So even if we're, like in Ukraine, where, it's a proxy war that the U.S. has funded and is actively getting itself involved in, that still might make the dollar stronger. That still might lead people in other countries to want to buy, Miami condos or Iowa farmland or something like that, just to have a safe place that is liable to survive what's coming for at least part of their capital. So currencies are a little trickier in all this, but I think you can say with certainty, equities bear market for sure, and then gold and silver probably, or at least gold for sure, holds its value throughout the craziness. Everything else is a total crapshoot.
Do you think the U.S. dollar will still be the go-to fiat currency as the world becomes less and less stable?
Yeah. Well, okay. Two things about the dollar. We're actively inflating it away. And so the dollar is going to lose purchasing power almost regardless of what happens in the world, because we've built up so much debt that there is no choice but to create enough new currency out of thin air in order to manage the debt that we've taken on in the past. And that's inflationary. So that will push the value of the dollar down irregularly. There'll be little deflationary blips, but over time, the dollar is going to lose value. So calling it stable is going too far. But it still, during this process, might look like the best bet among a lot of horrendously depreciating currencies. So the dollar might hold up versus the euro and the yen, and people on CNBC or someplace like that might call it strong, but it's actually going to be losing value dramatically as this all plays out. So, it depends on your point of view. If you're, say, Eurocentric, and a lot of your assets are in euros, and you're trying to decide what to do, and shifting them into dollars might make sense. But if you're rational, like gold bugs and stackers and preppers, you see this for what it is an aggressive inflating away of all the world's major currencies, with the dollar maybe falling in value more slowly than pound sterling and the euro and the yen and maybe the yuan, but still losing value. And so you want to get out of the whole fiat currency complex completely if you can do it. And so you want to buy gold and silver. So regardless of what happens to the various currencies when valued against each other, they're all going to lose value. And gold and silver are all going to go up when denominated in these currencies. So you definitely want to be out of fiat and into real assets. And that's gold and silver, that's farmland, et cetera, et cetera. We've talked about the universe of real assets that governments can't create more of out of thin air, and that's where you want to be.
The BRICS are meeting later this month, around the 23rd, the 24th. They're going to be discussing their digital currency, the unit, that's pre-trading value, roughly $20 U.S. Do you think they're going to enact this counter currency to the U.S. dollar?
I don't know. They fooled us last time around when they said they were going to do something like this, and they didn't. But as part of the misdirection, they announced that they were inducting Saudi Arabia as one of their members, which might even be bigger than some little half-ass currency that they weren't ready to launch. So now, in the previous year, or in the ensuing year, since last year's meeting, the U.S. has done so many crazy things out there from the point of view of the BRICS countries that they have serious incentive to take some big steps to wean themselves from dependence on the dollar. So what those steps will be, as we found out last year, we can't know what those steps will be. But, I think it'll certainly be the induction of a lot of new members because countries are lining up to join the BRICS coalition right now. And a lot of them consequential, in terms of either natural resources or political power or military power. So that will be a big part of the BRICS meeting, I suspect. Now, the whole new currency thing, we'll have to see. I think they have an incentive to do it. They've been buying gold really aggressively in the last few years. One result of which is that they have a greater ability now to back their currencies with gold because they have more gold. So we'll see. It's going to be very interesting. I think that will be, well, I won't say that's the defining story of October because, World War III. But I think the BRICS thing is definitely very consequential and we should be watching, but I wouldn't even guess about exactly what they're going to announce in terms of a currency.
If they do go to a gold-backed currency, 40% backed by gold, what would that do to the gold market?
Good question, because if it means they've bought enough gold and they're done buying, then that might be mildly negative for gold. But if gold is the new bedrock asset in the coming global financial system and the BRICS are leading the way, then that means a lot of central banks, plus a lot of individuals, don't have nearly enough gold for that evolving world, and they're going to have to buy it at whatever the market will bear. So, I think we should be adding gold because the big currencies are going to have to be inflated away. So it's a buy regardless. But the BRICS thing could be an impetus for accelerating the process. It could be a catalyst for panic buying of gold out there. We'll have to see. And it really shouldn't necessarily change any of our behaviors. We should be stacking right now. But this could turbocharge the process of de-dollarization, which would, by and large, be really good for gold.
Canada's Bank of Canada, central bank, announced just a week ago that it was winding down its efforts to bring in a digital Canadian dollar. Is that good news for Canadians?
That might be the first piece of good news to come out of the Canadian government in 6 or 7 years. Because it's, I love you guys, Jim, but you're an incredibly badly run country. Your government is quasi-fascist at this point. But them pulling back on the whole central bank digital currency thing, it could be that they were getting such negative feedback about it because it's become a political issue now because a growing number of people see CBDCs for what they are, which is not a streamlining of the trade system and an improvement in financial life for the average person. It's a control mechanism. It's a way to see everything that you do and everywhere that you go, and to control your behavior by being able to reprogram the currency in your central bank bank account. They can, with the CBDC, they can make your money go away if you don't spend it fast enough. They can forbid you from buying certain things or from contributing to certain causes like opposition politicians. And they can basically just take away your bank account completely. They can just wipe out your savings account if they don't like what you're doing.
Well, we
saw you really don't want to live in the world.
Well, we saw that happen in Canada with the Freedom Convoy to Ottawa. People had contributed, $20, $50, $100 towards the truck convoy, found their bank accounts frozen for months.
Yeah, so we know the government wants to do stuff like that. Now, that was technically pretty tricky for them. They couldn't just flip a switch. With the CBDC, it literally is a mouse click. So I think they got a taste of what it's like to be able to control other people's bank accounts. And now they want to be able to do it in a modern way instead of having to demand that this platform or that platform freeze these assets. That was cumbersome and public. With the CBDC, your bank account evaporates. And there's nowhere for you to go because you can't call the police because they are the police, the guys who wiped out your bank account. So that's the kind of world the government wants, or all the governments want. And, it's going to be a battle because Canada is kind of almost alone right now in pulling back from CBDCs. Everybody else is going full bore to set those things up, and including the U.S. Fed. So they're going to, as part of that process, they're going to make cash illegal, which takes us back to precious metals. You want a lot of silver coins if something like that happens, so you can transact privately. That'll be the only way left to do it. And that means that you really, really want to be stacking at this point. The more silver coins you have, the better able you are to evade the eyes of these new dictatorships that are evolving.
Well, Europe already has a semi-war on cash. You can't take out more than 750 euros at a time in cash. Yeah.
And so one way to do that, one way to eliminate cash as a consequential part of the financial system is just to do it piecemeal. You cut it from 1,000 euros down to 750, and then you cut it down to 500, and then 250, and that happens without people paying attention because hardly, or not a lot of people are taking out big amounts of cash right now. But once you're down to some small number that won't let you buy a used car, for instance, or won't let you transact in a lot of ways that people normally transact with, for instance, checks and things. They would do it in cash if it was more convenient, or maybe write a check or something like that. But once that becomes harder and harder, you reach a point where you're beyond the point of no return because your freedoms have been taken away to such an extent that what do you even say or do? It's just the way the world works now.
China is like that now.
China is like that now. Well, China has, China being China, they've incorporated social behavior metrics into their CBDC system. So you get what they call a social credit score over there. If you're a good citizen, you get lots of privileges, including access to your bank account. And if you're what they define as a bad citizen, you get less and less. You can't travel, and there's all kinds of things you can't do. One of the ways they define good citizenship is obeying the government. If you protest some government policy, or if you work for opposition politicians, which there aren't very many of those in China, but if you behave in ways that make you seem like you're part of a budding opposition over there, they just shut down your life, and they have the power to do it. So look to China for the future.
Yes, you get a jaywalking ticket, you lose a week of holidays. Now, gold, gold and to a lesser extent silver got through the summer doldrums in great shape and are now entering what's usually their seasonally strong period. What should we expect this winter if that usual seasonal pattern holds?
Yeah, with gold, normally the whole sell in May and go away thing is valid, as I've found to my horror a bunch of times when I say, okay, this time seasonality isn't going to work, and let me buy all these gold mining stocks or something like that, just in time to sit around for 6 months while those stocks just gradually lose value. This summer that didn't happen. Gold and silver both went up through what is normally the worst time of the year. So 2 points. One is if they violated seasonality in the summer, then maybe they can violate it in the winter and go down. That's, I guess, possible. The other is that there are broader forces at work out there that are swamping seasonality, and that, a big part of that is central bank buying of gold. Central banks have been aggressively, as we talked about, buying gold on a scale that is actually as big or bigger than the usual forces that make gold trade in a seasonal way. And the central banks don't seem to be done with that. So if they're not price sensitive anymore, they're just going to keep buying because they have a target in terms of tons of gold that they want to meet, then central bank buying could continue, gold could continue to go up, and it's not clear what the upper end of the range that we should expect is. Though I think at $3,000 US an ounce, you'll see a lot of resistance. So that could be a place where there's a lot of volatility, and we're really not that far away. One more quarter like the last quarter, and we're approaching $3,000 an ounce. So the way you deal with this is to recognize that the future, especially the near-term future, is inherently unpredictable, and just dollar cost average. If you're stacking, don't try to think, okay, well, this is going to be a great month, let me buy more, and then I'll sell some of that next month, which is going to be a crappy month, because you don't know anything. Nobody really knows what that is going to be in the short run. So just continue to buy with the same dollar amount each month. If you're throwing $500 a month at silver, then just keep doing that. And when silver is down, you'll get more ounces. When silver is up, you'll get fewer ounces. You'll end up with a pretty good average price. Just the important thing is to be moving in that direction, because we really don't know when all this stuff is going to hit the fan, although I suspect we're getting closer all the time. But we can't know what that means in terms of months or quarters or even years. But you do want to be moving your finances in the direction of real assets. So buy some uranium stocks along with all this. Look at copper stocks, oil and gas now with the Middle Eastern war brewing might be more attractive than it was. All of these things are real. Governments can't make more of them very easily. And because of that, when the dollar and the euro and the yen really get going, falling in a disorderly way, those real assets will just hold their value. So move in that direction, but don't jump into anything with both feet. But also don't just sit on the sideline waiting for a better price. Just gradually do what you should be doing, and you'll be okay.
LIT, the Global X Lithium and Battery Tech ETF, has had a very significant move since September. Is this likely a sign of shortages, more EV battery materials needed, or both?
Well, lithium is a tricky market for a variety of reasons. One is that there's no shortage of lithium in the world. Right? In fact, in the U.S., we just discovered this Saudi Arabia deposit of lithium around Oregon. And so, we could produce all the lithium that the world is ever going to need. The shortage is in refining capacity. So we got to set up the plants that turn lithium into actual battery material. And that takes a long time. So it's possible that there are, periods where there's a shortage and higher prices followed by a glut and lower prices. And I wouldn't presume to be able to predict those in terms of time. But we are adding a lot of electric cars, and we're using lithium-ion batteries for lots of other things. So, lithium has a market out there. Although I don't know how long that market lasts, because lithium is incredibly dirty to produce, which means it's not really green in any holistic sense, because, a lithium-ion battery-driven car puts out less carbon into the atmosphere, but that's completely ignoring what has to happen to get the lithium into the battery. And lithium-ion batteries have a habit of catching on fire and blowing up, and it's a very imperfect energy source or power source. I kind of think the world is going to end up with nuclear power plants running all night long when nobody needs that electricity, using that electricity to produce hydrogen, which then run fuel cells in tomorrow's electric cars, which actually are pretty clean environmentally, and also don't have all the weird lithium-ion issues. So I think that's where we're heading, and that of course would be bad for lithium in the long run. So so we're basically talking short-term market action with lithium right now, and this was a long-winded way of getting to I don't know. I don't know what lithium is going to do in the short run, because it's got so many cross currents, and electric cars aren't being accepted as readily as people expected them to be for a variety of reasons. But one of them is that lithium-ion batteries, eventually fail and have to be replaced. But you can't look at a battery and say, okay, you're going to need to replace this battery pack in 2 years. You can't do that. And it's incredibly expensive to replace that battery pack when it goes. So it makes used electric cars kind of a crapshoot. And so the prices of used electric cars have been going down dramatically, which has pulled down the prices of new electric cars. They're becoming a better deal. They're not more expensive now than internal combustion engine vehicles, but it still has, that kind of sword of Damocles thing is hanging over you when you buy an electric car, because you never know when you're going to have to shell out $25,000 or $40,000 or whatever for a new battery pack, which is why the electric car market has gone to leasing. So now what people do is they lease a Tesla or whatever for 3 years, because they know within that 3 years they're not going to be responsible for replacing the battery pack. And so leasing is turning out to be a better way to own these cars. And then what do you do with the used cars? A car coming off a 3-year lease might be kind of cheap to buy, but you just don't know when you've got this huge expense out there that's looming over you when that expense is going to hit. And I think that's a big issue with electric vehicles. So we'll have to see. But I think hydrogen is going to end up being the fuel of choice for transportation and a lot of other things in the future. So we'll see. That's my non-expert guess, but combining it with nuclear produces a really interesting energy ecosystem that, if it could be made to work, I think would be a lot more benign than today's.
Mining stocks normally outperform the underlying metals in bull markets. How have the mining stocks been doing so far, and what do you see ahead for them?
Yeah, that was a long stretch of disappointment for the mining stocks and their investors. But they're starting to kind of get with the whole gold thing, and the reason for that is when you're digging something out of the ground and selling it, if the price of that thing that you're selling goes up, your revenues go up dramatically. And if you control your costs, then all that extra revenue goes straight down to net earnings and cash flow. And if that happens, then you suddenly become a much more attractive stock, right? Because your earnings are growing at a rate that puts you on the radar screens of the momentum guys, and you get a lot of extra money coming in, and that's how it normally works. And then the miners outperform the underlying metals because people are excited about them, and they're highly leveraged relative to the metals themselves. So the miners outperform their underlying metals. That hasn't happened so far, but it's just now starting to happen, which kind of implies that $2,500 an ounce gold is the point at which the operating leverage becomes noticeable to generalist investors. And what's going to happen now is that third quarter earnings, which are going to be reported pretty soon, are going to be even better than second quarter earnings were, because gold has gone up in the past 3 months. And so you're going to see a lot of pleasant surprises out there from the big miners. And that's going to get people who weren't previously paying attention excited. So I think it's completely possible that the miners continue to outperform the metals as long as the metals hold up. If they don't just tank from here, then I think we have a good 3 to 6 months for the miners going forward.
A month from the U.S. election, the American government just announced that more jobs were created than expected, and unemployment has fallen to 4.1%. Believable numbers?
No, the U.S. government lies about employment numbers. Here's an example. We reported excellent jobs numbers for a whole year, basically, surprise, surprise, heading into a presidential election. And then finally, the imbalance between the jobs we actually created and what we were reporting became so huge that they had to do a big revision where they eliminated 800,000 jobs and said, oops.
Oh.
So all those jobs we said we had, 800,000 of them never actually happened. And another aspect of this, which they're actually reporting but nobody's really paying attention to, is that all the jobs that are being produced are, first of all, part-time jobs. Second of all, they're going to people who were not born in the United States. The new jobs being created for people who have been born here are actually shrinking. So immigrants and part-timers are, yes, they're finding work, but people who are born here are actually being thrown out of work at an accelerating rate. So that's another aspect of the whole jobs thing that really isn't publicized as much as it should be. So what we'll see here is the election year jobs numbers that were just reported will be they'll be revised away after the election when it doesn't matter anymore. And in the meantime, the party that's in power can say, look at all the jobs we're creating. We are running a beautiful economy, that kind of thing. They can lie going into the election. And that's all this is.
John, anything else we should be keeping a close eye on right now that maybe is below the radar?
Oh, about 1,000 things. This is a complex world with a lot of stuff going on. Much of it deeply disturbing, but I'm kind of out of time now. I have to one of our stocks in my Substack newsletter just announced that it was being bought out this morning. So I need to go write up that notice and send it off to subscribers because we finally had a buyout. And I'm at Rubino.Substack.com. And if you want to see what the stock was that just got bought out and see which ones are next, I'll be writing about that this week.
And where is the best place for listeners to follow you? Rubino.Substack.com. It's a newsletter dedicated to helping people figure out how to navigate what's going to be a crisis-filled decade. John, thank you so much for being on This Week in Money.
Thanks, Jim. See ya.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, as you heard. Find him on Substack at Rubino.Substack.com. Coming up, Robert Campbell, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter. His website, realestatetiming.com. He's speaking to us from beautiful San Diego. Welcome back to This Week in Money.
Thank you, Jim. Glad to be here. Hey, for everybody out there that's not in Southern California, I just want you to know that it's 72 degrees Fahrenheit, and there's not a cloud in the sky.
Is the latest issue of the Campbell Real Estate Timing Letter out?
Nope. One just was published 2 weeks ago, in September 15th, and the next one will be out in November of this year, November 15th. I publish 6 times a year, once every 60 days.
The war drums are banging loudly. What could this mean for inflation?
It means inflation goes up. That's what it means. So all of a sudden, you might see that and I'm not saying that just because that's theoretical. You go back in time. And look at what happens during periods of war, and inflation increases because deficit spending, goes off the chart to the upside, and deficit spending is the number one cause of inflation. So you get these periods of heavy inflation during wartime periods. That's why during wartime, and that's why a lot of times they think putting price controls is the thing to do, so everybody doesn't get screwed, and all that does is create shortages. There's no avoiding the problem.
Due to war, could higher energy prices lead to higher inflation, and then that leads to higher interest rates?
Yep. Well, higher oil prices is a very, very is a commodity that's required, and a lot of oil gets used every day. But also you have other commodities, like copper and zinc and foodstuffs and things like that. All that stuff goes up during inflation.
With the war machine ramping up, are we likely to see more and more debt created out of thin air?
Yeah, exactly, as I just explained. These war efforts, either where they are now or what they're going to increase to, are not being financed through taxation of Americans. It's all debt that's created out of thin air. We owe another $1 trillion, and we hand the $1 trillion to the U.S. Treasury, and they give it out to, the politicians get their 10% skim, but after that, it all goes out to the Department of Defense, Pentagon, and other people to use as they see fit, and that's increased demand. All of a sudden, you have $1 trillion worth of cash in the system, and that sparks demand, which sparks inflation.
Do you think the push for World War III just ahead of the November 5th election is a coincidence?
You know what? 5 years, I would have said, you guys are all nuts. Now, I'm not so sure. No, I don't think there are any coincidences anymore. All these coincidences, all these things that I thought were far out, conspiracy theories, 90% of them have turned out to be true. So knowing how bad politics is, how corrupt it is, that would they do something like that to disrupt the election? No. They also might try to kill Trump over and over and over again. These guys are desperate. This is like crazy times we're in right now, for sensible people, that to look at this and go, what the hell's going on here? I mean, this is acceptable behavior? So I think that the deficit spending could get even higher. It's going to get higher and higher anyway because Medicare's running out of money next year. So all those funds that are paid out, which is like $1 trillion or $2 trillion a year, are going to have to be financed with debt. So I see inflation as being a persistent problem for some time.
What do you think of the port strikes in the U.S. could do to the U.S. economy?
Oh, yeah. It could be really bad for the U.S. economy. If these port strikes continue, something like 40% of all the total U.S. GDP in goods and services comes through the ports. So just kiss that goodbye. So all of a sudden, everybody, a lot of people are going to lose their jobs or get laid off for a while until the ports open back up. So it could have a dramatic impact on the economy. It could have a dramatic impact if the economy was free just to employ its own, resources, whether, what to do, what do people do under these circumstances, and leave it alone. It'll take care of itself. But normally the government's going to get involved, and probably everybody that got laid off would probably get paid, enhanced unemployment benefits that were like double what they should be. And so that could lead to inflation right there. And that's what happened during COVID. Same thing happened during COVID. We created, $7 trillion during a 4 year period. That's amazing. And then that's why the national debt is such a big problem. It's a huge problem. So, but it's also exciting. As a market watcher, I'm very, very excited by all this. I don't want anybody hurt, but you know what? This is the history of life, guys. Things go up, things go down. Wars are created, wars end. What happens during the war to the economy? What happens after the war to your economy? What happens to real estate before? What happens to real estate after? And all we have is history to look back, but I think we're clearly in a wartime economy right now, and that I would guess it's going to get worse.
Would automating the ports likely bring efficiency and a decrease in crime?
I don't know about the decrease in crime, but the efficiency probably. I mean, I don't know what kind of equipment they can use that they have to employ, to eliminate those workers. I mean, you can't eliminate them all, but so I don't know to what degree technology is going to impact anything. Yeah, if they said you can't use cranes anymore to unload the cargo boxes off the ships, I think that's going to be a big problem.
Well, the port strikes in Vancouver were over the issue of automation. The longshoremen didn't want to be replaced by robots.
It wasn't money. It was all automation.
Well, money's a part of it, but also automation was a big part of it. AI's threatening everybody's jobs.
I know. I don't follow it that closely, but I do know that what they're asking for in money, I understand it's 77% over 10 years. I don't have a problem with that at all. I know what inflation really is, and 7.7% or something like that per year over a 10-year period. Yeah, I mean, are you going to get rich on that? Relative to inflation? No. You'll probably hold your own, which is better than 90% of all people do. So, I think they ought to be paid. But the automation, I don't know what the hell they're talking about. I mean, hey, I've been in Seattle. We're both from that, the Northwest. In Seattle, that's where all my relatives live. The operations in Puget Sound for ship handling and cargo handling, I've taken tours through that setup. That's a big deal, Jim. That's a big, huge operation right there, dude.
Well, Vancouver's very much the same. Now, what happened?
I was shocked. I was going, whoa! That how tall those containers are piled up on those ships, and then how tall they are on the docks. I mean, there's like miles of that stuff. You know what I mean? So all that shuts down. What happens? We're going to find out, huh?
What happens to housing markets during times of war?
During times of war, usually housing prices, and I'm looking at a chart here. Let's talk about real housing prices. So we take whatever gets reported in business as the housing price. If you subtract inflation, the rate of inflation, that's what's called real. So real housing prices here. I have a chart going back to 1890 from Robert Schiller, and at the start of World War I. Housing prices, all of a sudden took a spike up and then kind of dipped down. And 5 years later, World War I ended. That was in ended, and housing prices took a dump, big dump, based on inflation. So during the war, they held their own. After, they took a dump. World War II, when they started, real interest rates. Real home prices started to go down a little, but then they recovered like 2 years later and actually ended up higher. So it was like kind of a dip, and then they took off. And after World War II, the housing prices, went up for about 5 years before they started going sideways relative to inflation. Yeah, so, that's what history's showing you. So, in other words, what it's saying is housing wasn't good investment during World War I, during that period, and it was okay during World War II, but it was a roller coaster ride that probably would have scared you to death.
What have wartime economies looked like in the past?
I haven't experienced any. So I'm a big guy on experience. Those are the things I know the best. But during wartime economies, for example, my dad was a Marine during World War II. He fought at Okinawa. In fact, I'm named after one of his buddies that got killed at Okinawa, so that's pretty cool. But so Mom was home and in the States, and Dad used to mention after when we became kids that he would get Mom nylon stockings, because that's what women like, that stuff, and they were really hard to get because that during a wartime effort, certain products just all had to go to the government and not to private industry. And private industry wasn't making nylon stockings for women as a general rule. They were making weapons of war. So some of these things, so that's all I know. And women like to look nice, and that my mom was in that group. And so when Dad, somehow finagled nylon stockings, bought them somewhere, that it was a big treat for her.
On the positive side, the Dow and S&P 500 have been hitting new all-time highs. What do stock markets tend to do during times of war?
Okay, I have another chart. Start of World War I. Stock market was kind of low. I mean, it started off at kind of low, and then it went up, and it did well during World War II. Start of World War II, the stock market, and this isn't real return. This is just nominal prices. It kind of ended up at break even. It started going up. You see, here's 40. The war started at 40. Okay, it went up. It went up during World War II, too. Yeah. Now, during the Vietnam War, which started, let's say, in the 60s, the stock market went nowhere from 1966 to 1982. So we're talking 16 years where the stock market just went sideways, and that was during the Vietnam War. But generally speaking, wartime economy is good for the stock. It's more likely to be good than it's likely to be bad.
Gold's been hitting new highs. What does gold tend to do during times of conflict?
During times of conflict, most people believe that, and mistakenly so, that gold is a good inflation hedge. That it rises and falls based on the rate of inflation, and that's not true. Is inflation a good long-term bet against inflation? I mean, the gold? Yeah, it'll hold its own. But it's going to be a roller coaster ride to get there, guys. I mean, gold went from $250 an ounce back in, what was it, 2000? And it went up to $1,100 when was it, 2011? So we had a 10-year period where it went from $250. It increased in value by 400%, by 300%. Then what did it do? Then it started going down. So obviously, you take us to today. Are we still doing fine? Relative to going back, to where it was in 2000 or even further back. Real estate holds its own, financially. Secondly, but what is more subjective, based on human behavior, the price of gold can move with people's confidence in the government. If you don't trust the government, people will move their money into gold. And that could help explain, a lot of the upward movement in gold. But what most people don't know is where the huge demand for gold is coming from. Is it guys like you and me, the private parties? No. It's from central banks around the world. That's the majority of the demand. They've been loading up on gold the last 5 years. I mean, relative to what they want, that's what they want. They want gold. They don't want U.S. dollars. They'd rather have gold. They think gold is somehow going to come into play, like with these new BRICS nations that are going to be trading in their own currency or have their own separate banking arrangements that don't include the U.S. I don't know how gold's going to fit in this, but I'm real comfortable with gold. I've been comfortable, with gold for, a lot of my life, and it's just, to me, it's it's a comfortable asset to own. But you have to own it physically. Nobody can know you own it. You got to put it in a safe place. You don't put it in a bank, and so that kind of thing. But in times of chaos, just let's take this to an extreme. You're not going to go anywhere with your real estate, but you can load up your pockets with gold coins and off you go, and you stand a pretty good chance of escaping with at least some of your net worth.
The Fed lowered the bank rate for the first time in this cycle by 0.5 point, setting it between 4.75 and 5%. Is this likely to cause housing and the economy to pick up?
I would say no and no. No and no. Because the reason they lowered the Fed funds rate by 50 basis points was not to spur the economy, but the U.S. national debt is reaching up around 1.2, 1.3 trillion, and at current interest rates, at 35, 36 trillion, and the current interest rates, the debt servicing per year is something like 1.2 trillion. And 5 years ago, it was half of that. Pretty soon, you start piling up the national debt. Then you get inflation that has a tendency to drive interest rates up, not down. Duh. And now the government's got a problem where pretty soon they're going to have to start creating debt just to pay the interest on the national debt. Isn't that crazy? Isn't that a crazy thought? I mean, look, you study history, you look at hyperinflations, you look at Argentina, you look at Brazil, and you go like, gee, this couldn't happen in the United States. Duh, wrong. Can happen anywhere. Depends how irresponsible you become, with your currency system, with your, your need to hold power, all that kind of stuff. People do crazy things. So I'm telling you that it's this national debt, even though I'm not like hyper crazy about it, it is a problem. I mean, now all of a sudden we're paying like, you can't even afford to make interest payments on the national debt, from taxation and cover everything else. And pretty soon that same situation is going to be with Medicare. Medicare is going to be out of money in, let's just say, 1 to 2 years. Out of money. Now, okay, are you going to stop paying benefits? No. Why not? You can't do that, right? Everybody would just die in the street. And, I don't think it'll come to that, but you never know. But, I mean, so that's got to be financed. So all of a sudden you start developing these deficits where the government keeps having to spend more and more and more money just to keep the wheels on the car, and inflation can get crazy. And that's a whole different ballgame, guys. What happens? Where you should have your money? You should have it in hard assets, I think. Gold, I think. Real estate, how's real estate do? It holds its own for a while. I mean, it's not a bad investment. The stock market does well during war, and so you just got to factor that kind of stuff in there. What are interest rates likely to do during war? They're likely to go up. What does that do to the price of bonds? It makes them go down. So in other words, during times of war, do you think you want to own long-term treasury bonds? No, you don't. Recession or no recession. I mean, this is just what history tells you. There's always the best place for your money and the worst place for your money, just based on future returns. So we try to figure those out.
Are there still real estate hotspots in the U.S.?
There may be, and they're up in the northeastern corner for some unknown reason. New Hampshire, Vermont, up there, that's the strongest area. I mean, last I checked the temperature there, it was way below 72 degrees Fahrenheit. So I, of course, have no interest in that area, but apparently other people do.
That's where the old money is. In the Hampshires, isn't it? The old money.
No, old money. Hey, that's where you think that money was well earned? Honestly earned? Yeah. I just heard the other day that AOC, that numbskull, is now worth $10 million. Gee, wonder how she wonder where that money came from. And think all of a sudden she turned into like a highly successful day trader? No. So, I mean, don't even talk to me about that wealth, where the money comes from. By the way, speaking of money, of all people that are considered rich, let's say whatever that definition is, let's say the top 10, let's say the top 5%, 5%. 1/3 of that money, they became rich by their own efforts for 1/3 of that money, like starting a business like Steve Jobs or something, and the other 2/3 was inherited.
Money the old-fashioned way.
Yeah, exactly. I mean, I just think that's an interesting statistic. I mean, I don't know how it compares. If you go back 100 years and look at what the percentages were. But I'm just kind of going, wow. In other words, 2/3 of the money in this country was never earned by the people that have it. That, to me, is like, wow. Okay, now what are they going to do? Right? I mean, that's kind of like, like these professional athletes in the U.S., like NBA, football. They play in the league 5 years, and, they make some money. 5 years later, most of them are bankrupt. I mean, didn't anybody teach you how to manage money at all at UCLA or something when you became an All-American?
Nope.
I mean, that subject, did anybody suggest that subject for you? I mean, it's just amazing. Human behavior is amazing, and that's the whole study of economics. And that's probably why I stay fascinated with it, because even though the cycles are clear, that no two cycles are alike. There's slight variations. And so, I mean, but do the variations negate the existence of the cycle? No, not at all.
Could the real estate bear market of 2006 and 2012 be a walk in the park compared to what's coming up?
I think it's going to be equal. It could be a little better. It could be a little worse. or a lot worse, depending on friggin' what happens with the war. What happens with the presidential election after that, and the riots start, and we start burning down cities again. I mean, who the hell knows what's going to happen in today's world? But I mean, but I would say, I think it's a great question.
Ross Clark, who was at the top of the show, once said to me that the definition of a recession and a depression: a recession is when your next door neighbor gets laid off. A depression is when you get laid off.
Exactly.
Right.
That somebody said that 100 years ago. Mm-hmm. I know, and it's whose bull is getting gored, right? And that's another big thing, Jim. The government today is Big Daddy. It determines who the winners and losers are, right? It's where the special interests are. Who's donating to my campaign? Oh, this guy that owns Olive Garden's restaurant. Yeah? Good. So, okay, we'll try to help him out as much as you can. That's the real world. Those are human beings in the real world. Nobody talks about it, but the fact that AOC is worth $10 million, and she majored, like myself, in economics. I've heard how she talks about economics. I don't even think if I had to guess, I would guess she didn't even take one class. I mean, not even the basics. I mean, it's just kind of crazy the way she thinks, about money and socialism and, and how we take all the money from the rich and give it to poor people and how that's going to, create, utopia. It's just nuts. History says just the opposite. So, you can disagree.
I would say most politicians have never heard of the Laffer curve that calculated governments make the most money when the tax rate is at 22%, and once you start to increase it beyond that, they make less money because you're taking money out of the economy.
They increase it too high, and people cheat. They start doing things with cash so they don't have to pay the high. People will do what they have to do, Jim, to survive.
In real estate bear markets, do sales drop first and then prices, and how are sales doing?
Yeah, typically, in my book, Timing the Real Estate Market, I identify 5 leading indicators to major trend changes in the market. And the first 2, number 1, is existing home sales. When existing home sales rolls over, and we're not talking about stock market volatility. We're talking about these long curves that kind of look like an oscilloscope, kind of a thing. Way up, way down, So right now we're down almost 40% from the peak in home sales. The most recent peak of Jan 2022 here in the United States, we're down 39%. Yet housing prices are still going up. That's crazy. And the only reason that explains that is the fact there's no supply. Everybody's still hanging onto their homes. So they can still afford to do that. People have enough money. I mean, who knows what's going to cause that to change? I mean, our market's changing right now. Yeah, just take a look at Florida. What's going on in Florida? Everybody thought in Florida was invincible. Oh, all the retired people are moving there, and they also need medical support staff to keep them alive until they die. It's a can't-lose situation. Nothing's can't lose. And now all of a sudden, it's not because of people, not moving to Florida. It's all of a sudden the hurricane thing has created problems with getting insurance and things like that, where it's gone way up or unavoidable. People are getting wiped out on their houses, and people are going, I've had enough of this shit. I'm out of here. Especially some of those people in those hurricanes, like they're getting hurt by Helene. They were hurt a year or 2 or 3 years ago from some other friggin' hurricane that came through. And in both times, their house was completely flooded. It was one of the first times that they had to spend all that money, take out all the drywall, rebuild the house. And so I said, okay, we should be good for now. The same damn thing happened 2 years later. And people go, okay, the mule doesn't have to kick me in the head more than twice before I get the message. I'm out of here. And now you have a lot of people just saying, I want out of Florida real estate. I mean, the risk, the insurance, the prices are so sky high. I mean, nothing's cheap. Now the insurance is going up. I mean, real estate in Florida, I mean, it's been, Miami's been a hot city, but that's been the hottest real estate, for a long time, other than it shifted to the Northeast. So things are changing. It's going to change, guys. We're going to have a big down cycle, a big correction. We're talking U.S. housing prices. I anticipate, based on previous cycles, that let's say whenever it starts. I called the top of the market in May 2022. And, based on price and real inflation-adjusted prices, I was right. Nominal prices keep going up, but pretty soon that's going to change. Supply is going to hit the market. Demand keeps falling. Supply starts going up. And now the equilibrium changes from a seller's market to a buyer's market. And, the correction is on.
Do high-end home prices drop first, thereby crushing the market beneath them?
I don't know about crushing the market income, the whole market, but high-end homes can be really, really volatile. Down where I live, in the city of Del Mar, there's 72 homes on 72 homes on lots that are right on the beach. I mean, you jump over the seawall, otherwise your house is going to be 2 or 3 feet underwater during high tide. You jump over the seawall and you're on the sand. 72 homes. Back at the peak of the market in 2006 in California, those homes were selling for $15 million. And I said, you know what? You can't get more front row center anywhere in San Diego than one of those homes. Yeah, the price tag's $15 million. That's a big number. But if you want to be if you're rich, have a lot of money, that's where you want to go. I said, those prices won't go down. During the next 6 years, during the correction, one home sold for $8 million. It had dropped 45%. It shocked me. I said, if I had $200 million and a home became available, would I buy it? Yeah, I'm a beach guy. I'll buy the damn thing. But evidently not everybody thought that way. So in other words, you could take a big hit on even, rare front row property, oceanfront in Del Mar. In Rancho Santa Fe, that's another very exclusive area here. I think it was during the 90s. All of a sudden, homes in Rancho Santa Fe, I think we're selling, let me just use an example of $100,000 a lot for a 3-acre lot. And that was expensive back then. You could buy a lot on the beach for 15 or 20. So $100,000. During the 90s downturn, I said, those prices won't go down much. They dropped 40 to 45%. I mean, talking about high-end, exclusive place to live, super rich, super success people. They're probably all trust fund babies, more trust fund babies today. But they dropped 45%. And the reason I mention land, because I come from a builder-developing, family. And, we buy things, we buy lots, we put a house on it, and we try to sell it for as much over that as we can to make a profit and do it again. That's our business. So I knew about lot sales. So, it can be really volatile.
Home buyer psychology. Would people continue to pay yesterday's price for high-end marquee homes when home prices are crashing?
Only morons. Or this. Okay, I'm talking about financially now. Now, if all of a sudden you say, I want a home for my house, I can afford a house. Okay, it was worth a median price home in San Diego now costs $1 million. So let's say the prices drop, from $1 million to $700,000, and the guy says, that's a 30% loss. I want to buy that home for my family, and we're willing to live in it. That's fine. You want to do that? Because let's say they only drop 40 or 50%, it's going to start recovering, and that investment is going to, because you bought it at such a 30% discount, and not the 40 or 50 you could have gotten a year or two later, you're still going to do really, really well with that home. Especially if you do some right things, like buy the right kind of home that needs a lot of work, ton of work. I'm not talking about repainting and recarpeting. I'm talking about really getting in there and adding some value to it, updating the home and, 2024 standards, instead of where it was, built 30 years ago, and just pimp it out. You can make a lot of money doing that. I've done that before. In fact, that's the best way I make money. I have the builder mentality. Either build a new home, create a new home that creates value and make a profit, or I buy an existing home, and usually it's the home that we live in, add value to it, sell it 2 years later, and make profit on that. Those have been the most profitable real estate deals in my life. Buying super high homes, but I know how to fix them up. I buy them at a good price, and all of a sudden, as long as you start fixing something up, you can even sell an expensive home in a downturn, because somebody's going to see that home. The woman buys the home, and she's going to walk in, and she's going to go, this home is amazing, and they got money, or so what if the home's, like 20% over market, anything that's ever sold. A woman walks in and she goes, "That's the home I want." And her husband goes, "This home's overpriced. From Campbell, I can buy this same home, 2 or 3 blocks down the road, for $30,000 less." And she goes, "Okay, we'll buy that home if you promise me you'll turn that home into what Campbell's just given us right here." And he goes, "Oh, hell, let's just buy this one." I mean, there's so much psychology in selling. I mean, you really got to know what you're doing, but the right property that's set up for people that want that home, and you appeal to people's emotions in an unbelievable way, those homes will sell. You're just not going to sell your run-of-the-mill garbage that, nobody's done anything, and it's really a fixer, but they want full retail price like it's a palace.
Now, this is an off-the-wall question. What's your favorite T-shirt?
So glad you asked. I had my own T-shirts made up, and I usually wear them at the gym, but out socially as well. And on the front of them, it has 3 words: "Why so serious?" ? And in today's society, this is my own psychological test that I use to have fun with people. Everybody has such a puss on their face nowadays, is so unhappy, pissed off, victim, and all of a sudden I wear this shirt around, and like when I'm in the gym, the first time somebody sees the shirt, they'll look at the message, "Why so serious?" and they'll look up at my face, and I'll be grinning, just kind of grinning at them. Then they'll look back at my shirt and they go, "Yeah, why the hell am I so serious?" Then they won't look me in the eye, but they'll walk away. And it's really interesting. That's just, and I have so much fun with that shirt. About 1 out of 20 comes up to me and goes, "Hey, I love your shirt, dude." I go, "Thank you." Nobody has a sense of humor. Everybody's walking around and I'm sitting there laughing. I'm just having a good time. I just give them a little smile. I like to create a friendly relationship between people. I get a lot of satisfaction from that. That's hard to do nowadays, guys. People are pissed off. Great division. And that's just not my style. So I wear that shirt and I just, every time somebody, and then the next time they see me in that shirt, they look at what it says, but they won't look me in the eyes afterwards. They look away. And then after that, they completely avoid me. You know what? They find it threatening. People find that question threatening. Like, yeah, why the hell are you so serious? I mean, come on, man. I mean, and so, but it's that's how I have. Those are my own cheap fun.
Bob, where can people follow you and buy your book, Timing the Real Estate Market, and subscribe to your newsletter?
Go to realestatetiming.com. Realestatetiming.com. And also, you might be interested in. I post. I have a blog where I post something like 3 times a month or something like that. And it's always pretty cool. It's always pretty cool stuff. You'll enjoy it. If it wasn't pretty cool stuff, I wouldn't post it. So you might want to go there and sign up on my blog post. And eventually, sometimes you might come to the conclusion, like, you know what? I need to know what Campbell knows, and either subscribe or buy my book or both or whatever. But it's all a choice everybody has to make. And I'll tell you, if you don't work hard and work smart, you won't get anything you won't get ahead in this world. You won't do it unless you have a trust fund, baby. But otherwise, you got to be smart and you got to work hard. And so, that's those are 2 good things. Those will keep you healthy too.
Bob, thank you so much for being on This Week in Money.
You're welcome.
My guest has been Robert Campbell. His website, realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Robert Campbell. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.